Welcome back, everybody. It is Money Monday, so you know what time of the week it is. It is
3:30 Central-ish.
Oh my gosh.
Welcome back. We do this every Monday at
3:30-ish, right?
There you go.
Yeah, boom.
We are live. We've been doing this for now, what, 2 years, a year and a half, somewhere around there.
I don't know. We started during COVID, so I think it was in the spring of 2020. So we're going on almost 3 years that we've been doing this. Plenty of content. Check out our YouTube channel. We record all of these things, so you can hear us banter back and forth.
I've been stuck listening to Ben for several years now. It's just, can't seem to get away from it.
We go over plenty of topics, and if you want to hear us talk about a topic, please drop those in the comments, email us. We love participation. And so today, what are we talking about, man?
We're talking about 2023 goals, forecasts, and strategies.
Ooh.
A little bit of everything.
So this is that time of year that you should already be working on your goals. If you haven't, you need to be doing that this week, right? Because doing them in January, you're not really you're gonna at least burn a month of your year just developing the goals that you should have done in November and December. So just like budgets and everything else, that needs to be done in November, early December before the holidays, so you can roll into the new year with all of that buttoned up. So we're gonna get right into it, man. So I'm gonna ask you a couple questions.
Go for it.
What is the current state of multifamily real estate right now?
It's in discovery mode is my final answer. Right now, and I actually literally have a broker calling me as we speak. Ultimately, I think it's starting to settle, right? Especially with last Thursday's announcement that they're going to keep the increase at 50 points and not 75. So I think things are settling, right? At a new low though, right? You know, prices has gone down quite a bit, rates have gone up because, accordingly.
Yeah.
And I think it's starting to it's kind of hopefully getting past the unknown, and now it's just an unknown. And so I think things will start to flatten out.
We'll one see. Unknown versus two unknown.
And so, I think it's just it's on the tail end of discovery mode. Maybe is the
no,
my simple
I think
answer.
and when he means price discovery, folks, right? Like what is a seller willing to accept versus what a buyer is willing to buy it for, right? There needs to be an equilibrium there, and I think the cost of capital shot up so much, and sellers were still way up here, right? So there wasn't an equilibrium, and a lot of deals blew up, right? And then the people that made it out on the other side of it, which was us. We had to force those sellers down to where our cost of capital was, right? And we ended up getting 5, 10, 15% discounts on our deals that we were under contract on over the summer. Things are probably going to bottom out, I'd say, from the peak to the trough. Call it anywhere from 10 to 20%, depending on what submarket you're in. We invest in the Sun Belt; things are still going strong. There's other parts of the country that aren't going to go strong, and certainly aren't going to go strong when a recession hits either, right? Which kind of goes into our second question, which is why has demand remained so strong for multifamily properties for so long? I think ultimately it just depends on where you're at, right?
It was kind of the darling of,
And it still is. I think in a lot of ways it still is the darling of a lot of asset classes. It made its way through COVID and really, really it was like a rubber band. It just got shot out and then values just skyrocketed and so did rents.
Yeah. And the fundamentals are attractive, right? That's the thing. Why it's the darling, the fundamentals are attractive. That's why people, including ourselves, like multifamily, right?
Yes.
With inflation, you get usually rent growth. Sometimes you get some other factors like job growth, population growth, right? Those things happen. And so given enough time, multifamily is a very attractive asset. Now, time in the market is better than timing the market. Oh, but again, it's a great asset class that things haven't changed. People are not living in apartments any less, right? People still need a place to live, right? Storage, again, like you could argue, storage is a weird asset class, but guess what? People are also storing just like they used to, if not more. Yeah. And so some, but there's other asset classes where things maybe go less.
Let's go to
Hotels is a good example. During COVID,
well, I was going to say office too. Right?
Office is another good example, right? People, there's still TBD on what happens in the office. So not as attractive an asset class because there's a lot more unknowns. Now that said, pricing is low. Maybe there's a chance to get into cool deals, and we're looking at stuff, but. Again, it's not as straightforward and simple as multifamily is.
No, absolutely. So,
and by simple, I mean fundamentals. Operational, it's a whole other,
Oh, story. Yeah. It's the most operationally intense part of any asset class. That's why, obviously.
After hotels.
After hotels, right? Hotels is a service business, right? So you have to, each day you're catering to a new client, right? Whereas, multifamily at least have 6 to 12 months to wow them and get them to renew. But a lot of things can happen because that's somebody's house, right? So current state, Still in the equilibrium price discovery. I think we're getting there, right? I think the Fed has kind of tipped their hand as to what's going to happen in the future, which is we're still going to have some rate increases. How many? Who knows? They're not going to be as deep as the 75-point, rate increases that we've seen in the past. It's going to be probably 50, then maybe 25, then maybe 25, and then it's probably going to stop there for a little while, and then it's probably going to start going back down. That's just what we think. Nobody has a crystal ball.
I'm betting it's going to be 350s.
You think 350s? Oh,
I don't think it's going to be one.
I'm not going to take that back because I don't know, and he doesn't know that either. But that could possibly.
No, if I say it definitively enough, it's going to happen. Right.
But demand is still there. There's still buyers and sellers. It's a liquid market. There's still debt there. Equity is still looking to do deals. We have a deal here in Houston that we're looking to launch here. It's called Hollister Place, and really excited about that. And we have a ton of people lining up to put their money into that deal, right? Because they want their bonus depreciation before the end of the year. But moving along. What are renters looking for today for multifamily properties? So this is, again, we're talking about forecasting and strategies for 2023. I think technology is going to continue to be something that property management companies and owners are going to adopt more and more. I think being more pet friendly and having more amenities when it comes to pets is going to be something that a lot of renters are going to continue to look for. A lot of people, all of them, especially like in Austin and some of these more kind of urban markets that we have properties in, everybody's got a dang dog. There's some people that got cats, but mainly dogs, right, that you have to kind of cater to. So you want to make sure you have your bark park, which is a dog park, folks. You want to maybe even have a pet washing station. You want to have stuff that's going to cater to being a pet-friendly community. Back to the technology piece, right? You want smart home living was what everything everyone wants on an app. They don't want to carry keys around. It's a pain in the butt. They want to be able to get into the fitness center with the same app that they can get into their home, right? And also ultimately having some maybe smart home technology within the unit is important too, right? Maybe a Nest thermostat or some kind of a whole thing that can control, from AC to the alarm to everything in between, right? We're seeing more and more of that. I think that going into 2023, you're going to see more of that as well, right? So I think that renters are looking for that. That's just kind of been a holdover. And I think renters are also kind of looking for, space where they can work from home if they still want to work from home, right? Those little cubbies and those little work nooks that you see in some properties, those are really much in demand. So are the townhome units, right? Where they've got enough space where it kind of feels like a home, but it's still an apartment. I think those are still going to be in demand. So a lot of the stuff that was really still in demand from 2021, 2022 is still going to continue. I don't see that changing. In fact, I think that's just going to accelerate, right? So moving along. Do you see demand for apartments, both from renters and investors, continue to hold steady or rise through the rest of this year and into next? I think ultimately, what do you think?
Demand from renters, I think, will stay as is, right? There's not really a driving factor to increase demand, except for the argument that, hey, as rates have gone up, people can't buy houses, so therefore they must continue to rent.
I think there's a subset of people that affects, right?
A little bit of that.
But it's not going to be a huge. It's only 20% of the population was going to buy a house next year, and now they can't buy a house because of the interest rates. But there's call it 3 to 5% that maybe fall into that bucket.
Yeah, and
right?
so demand, stay the same, slight increase, right? And again, that's why it's attractive. People will rent in a bad market, right? Mm-hmm. I'd say investor demand, I think this year second half obviously was super weak. I think it'll probably still be kind of like sort of flat for the next couple of bits. That's where you can find the right assets.
I think for the first half of 2023,
I think the second half demand might go up, but there's also going to be a lot more product too, because I think the things are going to be.
I think the people that might be in trouble is what he's alluding to. There could be a buying opportunity. So now is the time, and I've been telling people this on podcasts and events that I've been speaking at the last couple of months, is now's the time, folks, to be getting yourself educated. Now's the time to be having conversations with your investors and getting your money lined up, right? Unless you're an experienced, vertically integrated firm like us, it's very tough to navigate today's market, right? And that's not just to pat ourselves on the back. I'm just telling newbies should not be trying to buy a deal right now. You're going to get annihilated, right? Because there's lenders that are real sharky out there, the brokers that are still trying to figure out what's a good deal and not a good deal. They're just throwing things out there to see what sticks. There's a lot of negotiation, a lot of back and forth that has to happen to get a deal across the finish line right now. So my advice to people that are getting into the market is get your powder dry, get yourself educated, find your partners, get your team together. Then on that back half of 2023, you'll be in a good position to go out and maybe pick up some good opportunities, right? I don't think it's going to be a complete bloodbath, but there's definitely going to be some people that are going to be hurting. And if you're in a good spot with these brokers, you might be able to sniff out those deals.
Yep.
So what can we expect in multifamily in 2023? This is just another question that kind of came in. It's just similar, right? To what I was just saying, right? That's what you can expect, is that the first half probably going to be a little bit slower. Second half, maybe a buying opportunity, or at least where it's going to pick up. So I think it's important for people to, again, get yourself educated, get your money together. What are your multifamily growth strategies for 2023? I think we're always going to be buyers. There's always good times to buy in the market as long as you're buying right in that specific and where the debt is in that market, right? You have to have somewhat of a crystal ball and forecast things out. But, to be 100% on the sideline, I'm against that, right? I think that there's ultimately always good opportunities. And we're already getting, just from brokers, because a lot of people have been sitting on the sidelines, they're just like, man, make me an offer. Throw something in there. Right?
There's always a price we'll buy. It just may not be what they want.
I'm just like, well, if you really want me to, I'll throw an offer in. And guess what? We're buying some stuff, and we're also getting the best and final and some other things. Again, it has to fit that buy box. Your returns have to be there. They have to be risk adjusted, right? Because there's a little risk in the market. Right, and you have to make sure that your interest rate is there, right? If you're using Fannie or Freddie, your interest rate shouldn't be anything less than 5.5 and it could be upwards of 6% if you're doing a Freddie floater, right? On your bridge debt, minimum 6%, probably closer to 7, right? So if your deal still works at those interest rates and you can refinance out if you're doing bridge, or you can hold on to it long term if it's a fixed rate, go for it, make an offer. But you also have to make sure that you can raise the equity. Because, we're still seeing a lot of people clamor for it, but there is some equity that's sitting on the sidelines too. So that's kind of our growth strategy, is just be in the market, be keeping our ear to the ground, continue those conversations with those brokers, and then continue to sharpen our swords too along the way, right? Real estate trends to watch for in 2023. I think we kind of went through a lot of that, right? And then,
I don't think any other big trends. Syndication will continue, right? I don't think that'll continue to grow.
There's more syndicators today than there was yesterday than there was the day before, right? I stole that from you.
I know you did. I'm trying to think of any other big trends we're expecting to see next year. Yes, there will be more of smart devices, some of that stuff kind of trickling in. But again, rentals have been the same for 1,000 years. Slight variations, right? But ultimately, you provide space, people pay rent.
That's true.
Right? It's not changed drastically. No, it's been on for tens of thousands. Not tens of thousands, a few thousand years.
Yeah, there's probably landlords.
There's landlords, absolutely. The Romans were landlords,
I know they were. I'm not saying it, but I'm just saying
I would have probably owned a Coliseum and had been,
really, I was
a
gladiator out there. I was chopping people's heads off.
But, well, actually, I thought you were the guy that was just holding the line.
I'm that guy. Dang, man.
Gladiator, man, you went straight to the top of that one.
Man, I'm Russell Crowe in this thing, in this example here. Real estate trends. Again, I think there's not really going to be trends. I think it's going to be a little bit of what's happening in 2022 is kind of almost like a lost year. I didn't see anything revolutionary that's going to really change the way that you operate or operate a property.
I'll say the trend. The trend is non-performing assets. That's my prediction.
Yeah, I guess. Yeah, but we just talked about that though, right? So is that trend or is that a forecast? At the end of the day, we think that there's going to be some buying opportunities. Again, like I alluded to earlier, this is just two people's honest opinions. Take it for what it's worth. Maybe it's not even worth 2 cents. But if you get your powder dry, you get yourself educated, you build out your team, I think that there's going to be a lot of buying opportunities over the next 12 months. So maybe that's one trend that we can go back on at the end of 2023, and you can tell us we're either completely wrong or maybe we were really right. Who knows? But fortunes are made, in these parts of the cycle, right? When things start dropping, the rug gets pulled out from underneath people. The people that had the powder dry are ready to swoop in on those. So, gets us all to developing goals, right? We've already done our 2023 goal planning for next year. We had done that in November. We expect, if you haven't done that yet, you need to do that within the next week or two. Do not be doing it in January, right? One of the things that we do along with other, I guess exercises that go along with goal planning is a SMART goal. Right, we've talked about this on this show in the past around the same time, right? So SMART goal, what does it stand for? Specific, measurable, achievable, relevant, and time bound, right? Those are important, right? And to kind of give you an example of one of the ones that we're doing, right? You know,
Don't tell our secrets.
okay.
Go for it.
I'll tell you one, right? You know, because it's relevant to the show, right? We're going to buy $400 million in multifamily real estate that's built at least 1990 and newer in Sun Belt markets by next year. So,
And if we struggle to raise the money, we're going to have Ben participate as a gladiator, and people are going to pay for tickets to the show, and we'll raise the rest of the money.
the Rainmaker, baby.
And I'll be the guy. I'll be the
Rainmaker.
guy holding back the lines for Ben. Don't worry.
I love it. I love it. So that's one of our SMART goals, right? You know, what are some of yours that you like, right? Dump those in the comments if you like. You know, give people something to kind of get their juices flowing, and you know, what can I do next year to move the needle, right? You want to be in this same seat next year and having moved the needle on your career and where you want to be, right? With financial freedom or whatever it is that you're trying to attain. Right? So those are some of the SMART goals, right? Specific, measurable, achievable, relevant, and time-bound. Those are all important. Plenty of information on there. Tony Robbins talks about a lot of this stuff. And also I'm big on vision boards, right? Put it up there. Get a board up in your office, or you know, even maybe at your home office too, right? And put some of the things that you're looking to do. If your goal is to live on a beach, put a beach house up there, right? If your goal is to buy that jet and be like Grant Cardone, put a jet up there. Right? You know, it's important to visualize what you're looking to do. And I'm telling you that every day you look at that, it's going to get buried further and further in your subconscious, and you're ultimately going to start moving towards that. So it's important. Boom.
That said, Money Mondays are every Monday, 3:30 Central. If you have comments, thoughts, questions, ideas, tips, suggestions, whatever, please go ahead and ask them. But let's see, we have a few. So Ronnie, long time to see.
Ronnie,
says, how are you
what's up,
buying your
buddy?
interest rate caps, and what strike are you buying at? Man, we've bought stuff this summer, and from the 2.5 to 3s.
Yeah, I've seen it. We've done it as low as 2.5 to 3s. Most of the time, the lenders aren't going to let you go higher than 3. You know, there's been a couple of situations where we felt like we needed to buy it down, and it was cost effective enough. But just know that if you're buying it down, it gets very, very expensive.
Expensive very fast.
Yeah, so. You know, I mean, I've spent more money on rate caps this year than I want to admit. All right. Any other questions?
Ronnie L says, thoughts on structuring pref equity into deals?
Yeah, I mean, we've done this too, man.
We like it with our own raised pref equity,
Yes.
and we've deployed in other people's. Would you do a pref deal today?
I think it just depends,
Yeah,
right?
it still depends.
I think I probably like it in other people's deals more than probably in our own. But we do have investors that actually, what we call a soft pref versus a hard pref, right? And the reason that we call it a soft pref is just because we're essentially raising our own pref equity class of shares, right? And for people that don't know what the heck we're talking about, look it up. But you essentially have senior debt, then you have preferred equity, then you have common equity, which is your main LPs, right? Preferred equity typically gets a fixed rate. They don't get any upside, but here's the kicker on why people would actually do that, right? Your common equity might get 6 or 7%. Your preferred equity might get 10 to 12, and they get paid first and they get paid back first.
But getting no upside.
But no upside. I mentioned that. So, but those are some of the advantages, and like people will be like, why the heck would I invest in that? Well, it's a lot less risky than the common equity, because a lot of things have to go wrong for that pref equity to get nuked. So they're gonna, even if the deal completely crumbles, typically the senior lender and the pref equity get paid off, right? Common equity might be the ones left holding the bag. We're not trying to say one is better than the other, folks. You have to look at it from a risk-adjusted return perspective, and each deal is different, right? But I'd still probably invest pref equity into a deal, and maybe we'll do it. We're not going to do it on these next couple deals, but we might do it on
Ronnie
something in the
says,
future.
great opportunity to be a pref equity provider right now.
Yeah, that's why I like it better, right? I think that's, and we've done that. We did a fund 2 years ago, right? We deployed the last of it this last year. Or this year, excuse me.
I think we did it. Yeah, about a year ago.
Yeah.
1 year
So
ago.
we did about 5, and we did it into 4 different deals, almost 1,300 units, right? So we're a pref equity provider into other people's deals, and I think that there's an opportunity there. But one thing to realize, though, folks, right? If you want to get into that game, you're competing against some bigger
other thing.
Yeah, you're competing against some bigger shops that their cost of capital is a lot cheaper.
Absolutely.
So something to think about.
Let's keep going.
All right. Any other questions?
No more. So if you got questions, thoughts,
All
comments,
right.
please leave them.
All right, so it wouldn't be a Monday Mondays without talking about the Multifamily Investor Network Conference. Oh my gosh, February 11th here in Houston.
This is the big one, folks.
This is the big one. Real
800 people. We've already sold. We almost sold out of VIP actually. We only have
Really?
Yes, sir, and that's it's only in a few days. So
Okay.
early bird sale is on sale. Prices will go up every week on the week. So get your tickets sooner than later. Don't be that person that buys the last second ticket for a lot more than you could have earlier.
Yes, be an overachiever and buy them now because this is the rock bottom price that you're going to get them at.
What coupon codes should you use, Ben?
Early bird at checkout, get the $150 off. Again, I don't think we're making any money at this point. So please take our tickets. Come hang out with us February 11th here in Houston. We're going to have about 700 or 800 people.
Absolutely.
A lot of great speakers, a lot of great panels, a lot of great networking. So come check us out. What is coming up next week?
Our year in review, what all we got done for the year. So we'll kind of share firsthand what's going on in the district offices.
2022, our year in review. So we will go through how was our year? What did we see? We kind of alluded to some of that here in today's show, but today's more about the goal planning because you need to be doing that right now. We'll do the recap next week and talk to you about what we saw in 2022, maybe some predictions again for 2023, and what we were predicting in 2021 that went right and most likely probably wasn't right at all. Absolutely. So check that out next week, Money Mondays, every Monday, 3:30-ish Central Standard.
Thank you very much. We'll see you all next time.